Hi everyone and welcome to the Dollars and Sense Podcast. I'm your host Dinesh Dayani and today we're coming to you on site at MooFest 2025 at Suntec City Convention Centre with a conversation on fixed income with market volatility and economic uncertainty becoming the new normal. Many investors are taking a fresh look at fixed income, not just as a defensive play but as a core part of their portfolios. Joining me today is Kylie Soh, Client Portfolio Manager for Fixed Income at Fullerton Fund Management. Kylie brings with her deep experience in managing fixed income strategies, and she's here to help us understand why bonds and other fixed income assets are becoming more relevant in today's market. Thanks for joining us, Kylie. Let's get started. Okay, so there's been a lot more discussion on fixed income lately, especially with the ongoing rate cut tussle between the new US president and the Federal Reserve. So why do you think more investors are more interested and paying more attention to bonds and fixed income market right now?
Yeah, so you raise a very good point. So a large part of my role is to speak to clients, investment committee, fund managers. So we do see a lot more interest in bonds in general. So one of the reasons is because yields are much more attractive today versus 5 years ago. So we're no longer in a negative interest rate environment. And also rate cuts are coming, even if they are delayed. So we think that inflation could be sticky or slightly rising, but it's not a threat to the markets. If you look closer to home in Asia, for a lot of Asian countries, inflation is within their central bank target. The dollar is weak, so this gives a lot of opportunity for the Asian central bank to reduce interest rate. And also to your earlier point, given the macro uncertainty, due to the tariff, it's a good time to think about bonds because bonds can bring along, can diversify a portfolio, can give you a lot more stability and predictability. And maybe to my last point, what we notice is a lot of what people call it as a de-dollarization theme. Maybe the past few years, everybody want to buy US credit, US S&P because they have to view that US is very strong, US exceptionalism. Now you see a lot of, because of the volatility and the unpredictability of Trump, everybody wants to move closer to home. So we think a lot of Singaporean investors are now looking at Sing bonds and Sing equities.
What are some of the trends and shifts that are creating these opportunities in maybe the Asian and Singapore-centric markets, and what debt instruments can investors go for today?
Something interesting to talk about would be the credit market. So in Asia and in Singapore, a lot of people are invested in credit market. So typically when you think about credit, you always look at it from three perspectives: fundamental, technicals, and valuation. So what I mean by fundamentals is the health of a company. So a lot of the volatility you hear in the news is very macro-driven. It's not driven at the company level. So corporate balance sheets are still healthy. Companies are not overly leveraged. Financial condition is very supportive. So what I mean by that is that companies can still get loans, can still get financing. The credit market, the primary market is very active. So fundamentally, things looks okay. So what we mean by technicals is demand versus supply. So in an environment where we see that because the yields are quite attractive, demand for credits is very robust. At the same time, supply is very well absorbed, so supply is very manageable. So in an environment where demand is healthy, supply is well absorbed, it's very good for bond prices. And the last thing that fund managers always look at is valuation, the price of the bond. So what we notice is that bond valuation are quite stable, credit spreads are quite stable, reflecting the strong market technicals, and also because fundamentals has been improving.
So, like you mentioned, right, while markets have been pretty volatile in the last couple of years, they're still trading near all-time highs today, especially the equity markets I'm talking about. So how can fixed income then come in to help, investors manage this uncertainty that we're still seeing, while giving them maybe an attractive return?
So a lot of the investors we speak to, I think they had bad experience in 2021 and 2022 with fixed income. 2021 because of the China property crisis, 2022 because of the very sharp hike in Fed interest rate. But I must say that bond funds has recovered in 2023, 2024, and so far in 2025. And looking ahead, we think it's a good environment for bonds because rate cuts are still coming, even if they're delayed. Then the Chinese property sector is stabilizing, even if it takes time. And to your first question, because of the tariff uncertainty, it could weigh on growth or risk assets. So it still makes sense for investors to still have some allocation to fixed income, where the steady coupon carry is going to have to support your investment. So for us at Fullerton, our view is that we don't think a US recession is likely, based on the signals we see in the market. So the way I would say is that the US economy, yes, is bending, but it's not breaking. The labor market is softening, but it's not collapsing. What we think is likely to happen is we could be going to a Goldilocks environment where it is not too hot and not too cold. Usually in the Goldilocks environment, it's quite conducive for bonds and credit bonds.
I mean, now that you mentioned that, I always think that we used to, or we still do, right? Many of us still do think of bonds as, a defensive play or tactical play. But now that you're mentioning these things, I think more investors are recognizing that fixed income universe is expanding. It's larger than just, government bonds, that there are wider types of bonds within that fixed income universe. So how is this diversity in the type of bonds enabling investors to buy different types, and how are they affecting different types of investors?
Yeah. So you raised a good point. So fixed income can be a core investment portfolio for many investors, yourself, including myself. So now with the cash rate coming down, you'll notice that if you are putting the fixed deposit or MS bills, it's coming down very fast.
Yes.
The latest auction is less than 2%. So what
Actually, I just checked it before this conversation. It was 1.85%.
Yes, exactly.
Right?
It's 1.85%.
It's a sharp drop from the start of the year even, actually, when it was, I think, closer to like 3% or close to 3%.
Yes, correct. So at the start of the year, it was more than 3%. So like my parents, they invested at the start of the year, so now it comes due, so they're rolling the bill. So I say, hey, Ling, how come so low? It's only 1.85%. So what I would say is that your top of your mind is capital preservation. What else can you do other than investing in bills and fixed deposit? Because the rate is coming down very fast. So you can think about buying high quality, very short interest rate bond funds. So this will be just a small step up, but it gives you return better than cash. If you are a investor who has been buying equity, so you have a longer runway, you are not so averse to risk, maybe consider a credit fund. So what I mean by that is bond funds that invest in companies, and some of that could be high yield credit. It produces a lot more diversity to your portfolio because of the stability and the predictability of bond funds. Because the coupon, clipping of the coupon is going to help to stabilize your overall investment portfolio.
Actually, just speaking about it, my wife's T-bills just got matured this month. Then we're actually looking into where to invest, and that's why we've seen the rates come down so steeply. So I think those are two very good opportunities that she can look at. So where do you think someone like her can, look into putting her funds that have just matured from a relatively high-yielding government bond?
It's a really good thing that you and wife are talking about finances and investing. It's a really, really good start. So what I would recommend for your consideration is just take a smaller step up. So rather than buying like bills and then keep rolling them at less than 2%, you can consider buying to a high quality, short interest rate bonds fund. So at Fullerton, we have one fund called the Fullerton Short-Term Interest Rate Fund. Okay, this fund has been around for 20 years, close to 1 billion in size. So 20 years ago, when we came out with this fund, we had Singaporeans in mind. So it was first designed for a government agency or stat board. So this fund actually just invests in two asset classes, Sing dollar credit and US dollar credit. Everything is hedged back to Sing dollar. So it's a fund designed for Singaporean investors. So the reason why we designed the fund this way is that the Sing credit market is very defensive, low beta. Because a lot of people who buy Sing credit are your government agency, institutional investors, stat board. So they tend to buy and hold. So the bond price don't move as much because there's not that much people dumping the bond when there is volatility in the market. The dollar credit market is a very liquid market. There's a lot of secondary trading, so the bond price goes up and down. So what we noticed for 20 years of investing in this fund is that in a risk-off environment, the Sing dollar credit bonds were underpin the performance of the fund. In a risk-on environment like 2019, the dollar credit will capture the upside gains for the fund. So the design of the fund over 20 years has worked very well. But at the same time, for a fund like this, short duration, we are not taking a lot of interest rate risk, high quality, investment rate only, investing in both Sing dollar, and a lot of these names, I think you and I will be very familiar.
What kind of interest rates can we expect on it then, right?
The way I think my colleague's wife invest in a fund, and the way he explained it was very good, and I use this every time. I was on the radio, I use it. I was at the investment committee, I use it. So the way he explained the fund to his wife is, this is like a taxi meter. It just goes so it provides slow and steady returns. So it's very suitable for people when you have a pool of money that you cannot afford to lose, but you just want capital preservation and protect you from inflation. So that would be very good for what your wife is thinking about.
Okay, so as we move into the second half of 2025, right, there are some key risks that we still got to look out for, I assume. Whether it's macro or geopolitical, it's in the future. So what are some things that you think we should keep an eye towards?
So when we think about risk, right, as a fund manager of one house, we always think of downside risk and upside risk. So you think of both sides. So of course, the downside risk is you're worried about US trade tensions will have a direct and indirect effect on growth. So what I mean by that is it's a tax, so someone has to pay the tax. Your purchasing power is reduced. Indirect because you and I are going to spend less, because of the uncertainty in the environment. And also the other downside risk is you're worried that inflation could be sticky or could be on the rise, and that makes it very hard for central bank to reduce interest rate. And maybe you're worried about geopolitical risk in the Middle East, which could mean higher oil price, which will mean higher inflation. So that's all the bad things, So we also have to think of the good things. So what happens if there are more, some positive upside risk? So the Trump administrator could be more pragmatic than we imagine. Trump could be more pragmatic. Maybe he will tone down the tariff. And if the tariff are spread out, so what I mean by that is the exporter will absorb some, the US importer will absorb some, the consumer absorb some. So we see that in the recent data by the Japanese automaker.
Okay.
So what we notice is that the Japanese automaker are keeping the car prices the same or lower because they want to maintain market share. So the increase in the tariff is not being passed on to the consumer. So companies could adjust well to the new norm. So these are the companies that you want to invest in. And also maybe think about China. China could pump up stimulus to support the economy. And also generally in Asia, governments could also increase fiscal spending to support growth.
So for someone thinking about adding fixed income to their portfolio today, what is the one piece of advice you will have for them?
So if it's your first time investing in bond, I would suggest going into a bond fund. The main reason for that is the capital outlay to buy a bond is very high. So each bond you buy is 250,000. So most of us cannot buy that many bonds, right?
Yeah.
So you're going to have very overly concentrated exposure in just a few bonds. So when you buy a bond fund, you will notice that as little as $1,000, you get exposure to 150 bonds, which you will never be able to do if you did not invest in a bond fund. And the other thing I will say is also maybe very interesting is that a lot of the companies that issue bonds in Singapore, they don't have any ratings from S&P, Moody's. So what I mean by that, if you don't really know what you're investing into, like is it a high quality AA company or this is a high yield company? But of course, when you invest in the fund, your bonds are being looked after by credit analysts. And maybe the last thing I would say is that start small. Start small, monitor the fund manager, monitor the fund, and when you're more comfortable, you can always add on.
I'm just wondering for a person maybe of my wife's age, right? So maybe in their mid-30s, what kind of percentage of their portfolio should be comprised of like equities and bonds?
So I would say this is my personal view. Actually, I think as investors, you cannot underestimate what Albert Einstein said. So compounding interest is the eighth wonder of the world. So first thing is she should stay invested. I will recommend probably 60-40 sort of ratio. Because 60 maybe more towards riskier equity, high yield.
Right.
40 more in terms of like bonds, where you treat the coupon, and maybe if she wants to have some bills or cash funds. And also within the 60 and 40, you should diversify further. So some things that what a lot of people are very interested in, and I don't know if you invest in this, is some people like to buy Japanese bonds or Japanese equity because the Japanese currency is a safe haven. So let's say when the Japanese equity sell off, your sell off is not so bad because you have the protection from the currency. So we see a lot of that angle as well.
Okay. So the age-old 60-40 portfolio might still be relevant.
Still work,
but even within there, you got to diversify, right?
Yes, and it's really good thing that your wife is already, at 30, she's really thinking about what she could be investing, and that's a great start.
I mean, I have to push her, but at least she started. All right, thanks for being on the show today.
Thank you.
If you are watching this episode, we hope the discussion on fixed income strategies has been useful for you as an investor. If you like our content, don't forget to follow us by subscribing to us on the Dollars and Sense Podcast, whether you're watching on YouTube, Spotify, or Facebook. Leave us your thoughts on the comment section wherever you are watching. Thanks.